Super. Yeah, so thank you so much, Nikhil. Uh, Welcome everybody to our fifth earnings call after going public. And this will be the month where I think being a public company, we'll probably complete in a year. That will happen on November 22nd. So first of all, thank you so much for really supporting us, and thank you so much to all the shareholders for really supporting us and getting us to this place and having the faith and belief in us that we would execute well. Um, uh, and Yeah, so let's begin. And I will take you through the earnings presentation of the second quarter FY26. Uh, Starting off with a snapshot of numbers, we did a total income, which includes the interest income and everything, about 167 crores in the last quarter, which is a 61% growth on a year-on-year basis. Last year, the same number was 104 crores. On an EBITDA basis, we did 37 crores approximately, which is a 150%, 143% growth on a year-on-year basis. Last year, the same number was roughly 15 crores. From 15 crores, this has moved to close to 37 crores. Subsequently, the profit after tax number is 29.2 crores this year. Last year, obviously because of multiple exceptional items, the number was negative of 270 crores. So that's a strong turnaround in the whole business. Relevant to this, because most of the business is determined by the key KPIs moving upwards, the whole transacting customer base for us has roughly touched about close to 8 lakh customers, which is a growth of roughly about 13% on a year-on-year basis. Metric which determines usage of our services more deeply by our users who use more than equal to 2 services, is roughly close to 4 lakh users, which is a 21% growth on a year-on-year basis. Payments being one of the critical parts, components of the revenue for the company, we report this separately. We did close to about 6,800 crores of GTV of payments, which is a 29% growth on a year-on-year basis, right? So broadly, summarizing this with a headline that, like, as we've always spoken in the last 5 earnings calls, we continue to grow, leveraging the tailwinds of the industry, leveraging the strong product portfolio which we have built, leveraging the new product portfolio which we keep experimenting and continue to launch. While doing that, we deliver profitability on a consistent basis, because the profitability comes from the core businesses which have matured over the course of the years and continue to compound on revenue, continue to compound on profitability. And newer businesses, we continue to keep reinvesting our profits and keep scaling them up. As always, for the benefit of new shareholders joining the call, we take a few minutes to repeat what our strategy is. A good part about the strategy is that it's been consistent over the last 6-7 years. We obviously iterated. Company started in 2015. We iterated through our way and probably landed upon this strategy maybe by 2018, 2019, and have been doing the same thing consistently the last 7-8 years, and this has delivered us results. Very simply put, 3 paths to the strategy. We innovate for our customer. We are in this industry to really reimagine everything, how it works in the transportation world. So we keep launching offerings for our customers, right? Our customer centrally being the truck operator. And a truck operator, typically an average 3 to 5 truck ownership is what India has. And keeping that in mind, we build products. These products, because everything is digital, are launched on our platform. And by launching newer and newer products on our platform keeps getting stronger and stronger. And customers use this platform repeatedly and more deeply. And nature of our customer, largely middle-aged, uneducated, and hence a distribution has to be unique. So, that's something which is very unique to our strategy, and we continue to, deepen and deepen on this. Offerings, as you know, our flagship offerings of tolling and vehicle tracking are our core products, which also drive majority of the revenue and profits today, with continuously launching adjacencies to these products, be it fuel sensor, be it fuel payments, right? And leveraging all of this data, consumer insights, to launch loads, to launch vehicle finance as we continue to build. And obviously, many such offerings are under the hood, which we continue to experiment, continue to launch. By the virtue of this, our platform continues to get strengthened. As you can see, the minutes a customer uses the app is probably, in the B2B world, one of the highest. For us, how we use the browser, how we use a social media app, a trucker for his business uses this app. So we have close to 8 lakh transacting customers, which is as near as about 25% of India's truck operators. Our app is very relevant for a large capacity truck user and for a long distance truck user, and hence relevant market share may be much higher. But then, like, our products long term will be relevant for everybody. So that's why we keep measuring this market share year after year, because we launch newer products. We are becoming more and more relevant for our users. The usage continue to deepen. On the distribution, we are present everywhere. It's like because our users need to be explained what our product value proposition is, and their trust with digital is not that high. We basically build trust with an offline network which explains and onboards our customers. So there's a 10,000 people touchpoint network comprising full-time workforce engaged by us, channel partners, variabilized workforce, tele-channel, like our technicians who basically install, repair a GPS device or a fuel sensor. Everything put together, we have a 10,000 people feet on street network through which we touch, service our customers, and obviously present very widely. Probably this presence is now closer to 90% of the districts all across the country. So that's what we do, right? And this is a strategy which is really compounding and delivering the results which you are seeing us deliver. Coming to the key KPIs of the business, which is largely all the key KPIs are trending in the way they've been trending over the last 4-5 quarters, be it monthly transacting truck operators, be it people using more than 2 services, time spent on the app, the GTV of payments, the payment transactions. Coming down to the revenue level, revenue from operations, removing the interest income from the total income, has grown about 53% on a year-on-year basis, from last year 99 crores to this year 151 crores. Net revenues from this has grown by about close to 38%, 99 crores to 136 crores, this particular quarter. Contribution margin has grown slightly higher, 41% on a year-on-year basis. And on an adjusted EBITDA basis, which basically does not include the ESOP cost, has grown from 19 crores to 43 crores, which is a 123% on a year-on-year basis. Most of these numbers would reflect the same trend on a half-year basis of this year. Every 6 months, we give a half-year picture. Reading out some of the key things over there, on an adjusted EBITDA basis, we've already clocked close to 90 crores in this particular half year of the full financial year. And the same number last year on a half-year basis was 31 crores, which is close to a 190% growth on a half-year basis. And similar narration would be for the remaining key KPIs. Taking these results and giving a little bit of voiceover on what's really happening, right? First, narration more on the overall revenue part. As a company, on the total income, we've grown about 61% on a year-on-year basis, and on a net revenue basis, 38%. If we split this number between the core business and the new businesses, the core businesses ended up growing 37% on a net revenue basis on a year-on-year, on overall revenue basis on a year-on-year basis, and on a sequential basis, 3%. As you all know, July, August, September is a rainy season, and it coincides with the little bit of trough in the overall trucking industry. Every industry which is let's say, has primary metrics from a trucking perspective, be it sales of trucks, be it loans in trucks, etc., typically has a bit of a low season quarter and starts picking up from the September, October month with the festivities coming in, right? So despite a low season quarter, on a sequential basis, we were able to do a 3% growth in revenue. And on the overall core business from a year-on-year basis have grown at about 37%. This year, important to note is that even in the core businesses, we've invested higher. As you can see at a company level in this quarter, year on year, our costs have grown up by roughly about 18%. And on a sequential basis, we have grown costs by about roughly 8 crores. Some part of these costs, not majority, have actually gone into the sales and distribution for the core business as well. And obviously, as you know, in our strategy, even in the core business, we've got a lot of adjacencies which we invest into and grow. And for a lot of these activation, we need to really reinvest back. So as you can see, one of the signs there, fuel sensor, which was one of the new launches probably about 2-3 quarters back, has already gotten bolstered as part of its overall sales portfolio. And in the last quarter, on a sequential basis, we've been able to grow about 55% on the fuel sensor. So that's the narration on the core businesses. Coming to growth businesses, as you all are aware that under growth businesses today, 2 relevant businesses for us are Superloads business and the vehicle finance business. Both of them have made good progress in the last quarter. And overall basis, the overall revenues on growth businesses have grown by roughly about 226%, and on a sequential basis have grown by about 19%. And largely, the gross revenue growth is because of the Superloads business. As you are all aware, today we are in the, are present in 4 hubs, largely materially present only in 2 hubs, and the other 2 hubs were largely for the return loads in a Superloads business. From the 4 hubs, over the next course of 6 months, we plan to open 10 new hubs and take this number in the range of 14, 15 hubs over the course of next 6 months. So that's where I would like to say that the update is that the whole playbook building, probably we are in the zone of 60%, and I think we've learned newer things. We've hit few milestones which were internally important for us to test ourselves to know that whether we really know how to scale this business. And happy to share that some of those experiments have gone well. Some of those scale milestones have got hit in some of these critical hubs, and we plan to sow the seeds, because whenever you typically launch a new hub, it has its own ramping up timeline. So we've decided that we will expand to 10 new cities over the course of the next 6 months and ramp them up while we continue to deepen in these 2 hubs where we are building our playbook. So that's the narrative on overall top line and overall growth. Moving into profitability, as I've narrated, we've seen a growth of 123% on a year-on-year basis in adjusted EBITDA, growing from 19 crores last year, same quarter, to this year 43 crores. That's a 123% growth, and as a percentage of net revenue, that's a 19% to a 31% kind of a growth, kind of a number on a year-on-year basis, right? And largely, the story remains same. This growth in EBITDA is led by delivery of operating leverage. We are in a business where most of our revenue comes from line items which are recurring in nature, and our customer retention is very strong and has a very high contribution margin. So if you look at on a quarter-on-quarter basis, the operating leverage is 65% because of the reinvestment in business which we are doing. If you look at on a half year to half year number, because last quarter we have presented the operating leverage of 85%. So if you look at half year to half year, the number still stays at 77%, from an operating leverage perspective. Giving you a bit of narration on EBITDA on a sequential basis. If you compare to Q1 26 to Q2 26, there's a small shrinkage in EBITDA. If we wouldn't have intensely driven, investments in our newer businesses and in our core businesses, obviously this EBITDA sequentially would have increased. But primarily, roughly anywhere in the range of 2 to 3 crores of investments have increased at a quarter level because of doubling down on Superloads and because of expansion of sales and marketing efforts in the core businesses, right? And another 1 to 2 crores each in the investments driven by in the subsegments of the core businesses, namely fuel sensor and AIS GPS growth, and obviously the annual salary increments as they happen on a regular course, right? So there are 4 line items which typically materially have led to the small reduction from a sequential EBITDA perspective. That brings me to giving you a snapshot on the P&L basis. Overall income in this quarter, 167 crores, as I narrated. If you remove the interest income, the number flows down to 151 crores. Overall net revenues, 136 crores, which is a growth of 38% on a year-on-year basis. If you remove the direct costs largely similar on a year-on-year basis, you get the contribution margin, and then total expenses. If you see on a year-on-year basis, this is probably the first quarter after going public. We have let's say probably loudly invested. That's why you see on a year-on-year basis, it's roughly about 20% growth of 71 crores to 84 crores on an overall expense basis. And on a sequential quarter basis, it has moved from 76 crores to 84 crores from a total expenses basis. And the same numbers largely hold good at a half-year basis. If you see, revenue growth is basically 55% on a year-on-year basis. Net revenue growth is 40% on a year-on-year basis. On a half-year basis, adjusted EBITDA 90 crores from last year 31 crores, which is a 190% growth on a year-on-year basis, right? And then removing the ESOP expenses, coming to EBITDA. Last year EBITDA was 15 crores. This year EBITDA is 37 crores, which is roughly about 143% growth on a year-on-year basis. 229% growth on a half-year basis from 23 crores to 77 crores. And commensurately, even the PATs not comparable because of a lot of one-time items. At this point in time, also want the shareholders to note that Uh, EBITDA in our business largely mimics the cash flow. So if you look in the annexures, the overall cash flow of the company in first half of this year is 130 crores, which is far higher than the adjusted EBITDA of 90 crores. 90 crores is the adjusted EBITDA, which generally directly moves into cash flow. Plus, because our revenue is amortized largely, so there's a deferred revenue element of 10 crores, which shows up in cash flow. So that's a real cash flow of 100 crores. And we had a one-time working capital rollback in our other part of the businesses, which contributed to 30 crores in increase in cash flow. That's why you see the overall 130 crores. But then always, as I've been guiding, adjusted EBITDA typically equals cash flow. A little bit goes higher because of the growth in the business, and deferred revenue comes into the cash flow but doesn't come into revenue. Right. Moving forward, giving you let's say a broader view of probably the last 2.5 years. As you can see, we continue to consistently compound in profitability, moving from like Q1 24 of negative 11 crores to this quarter of 43 crores, which is basically a huge turnaround over the course of 2 years. And if you look at the same numbers on a H1 24 to H1 25 basis to H1 26 basis, again a huge turnaround in terms of numbers. Again, reiterating, if you look at the H1 25 adjusted EBITDA of 31 crores moving to 90 crores, that's a growth in 59 crores in adjusted EBITDA. At the same timeline, the growth in revenue was 77 crores. That's a 77% delivery of operating leverage. So our strong track record of delivering profitability, delivering operating leverage, and consistent growth in revenue, continues. And we'll do our hard work, and hope God helps us keep growing that consistently, and keeps luck by our side as we keep moving forward. Summarizing our strategy, I'll take this point to reinforce on our strategy of what we are trying to do. Right, as all of you know, our core businesses deliver more than majority of the profits, more than 100% of our profits, for us. And tolling and vehicle tracking have been the leading vectors of our revenue base. They've been silently being added to by the fuel cards business and the AIS GPS business, which is largely a mandatory business in multiple states, which basically has helped us compound on revenue stronger, right? And by launching newer verticals like fuel sensor, and obviously there are many experiments under the hood which we keep doing, which will keep becoming core part of the revenues, right? So that is our strategy in core businesses, that we will keep innovating in adjacencies which will materially have the same revenue model, like be a payments revenue model, be it a telematics revenue model, and which will materially be using the same sales and distribution workforce to really leapfrog in revenues. So that part will keep growing, right? So there again, very key focus, tolling, by far the market leaders, like our market share is inching very close to 50% on tolling. We'll continue to compound on tolling. As you saw our payments GTV numbers, and if you compare that relevant to the NETC numbers, right, we've done far better than the overall industry averages, right? So our focus there is to keep sharpening our axe, keep making material investments, right, and keep leveraging the tailwinds and keep growing consistently, right? And there, one of the important things we've done is that probably our paybacks, blended paybacks in core businesses was as aggressive as 7-8 months. Now we've continued to invest back and see that even if this payback shifts to 9-10 months, we're okay with, but we have to keep doubling down on our market share and keep growing in that direction, right? So that's the approach in core businesses, where we will compound on revenues, which will help us compound on profitability because of operating leverage, and not be too very profit focused, but because the business model will deliver profits, but keep expanding market shares, right? So that will be the focus ahead, right? As you've seen us in the last 2 quarters, we will keep doing that. Moving into the growth businesses, right? Growth businesses is where, again, namely on the loads, there are 2 lines of businesses. Classifieds, which has a material market share on loads, has grown 65 to 70% on a year-on-year basis, right, for us. And that has led us to the birth of super loads, which is essentially the transition of the classifieds business model into a transaction business model of super loads, right? And super loads, as I gave a narration, that we believe that we've got material evidence, in terms of the playbook building, and we are really going aggressive on the super load side, right? And while the other businesses, because classifieds has found its own sweet spot, continues to grow all across the country, continues to digitize loads, makes the whole, I would say, playground ready for super loads to, really enter into these markets in an easy basis, right? Vehicle finance, again, partner-led calibrated growth, because we're dependent on partners. Partners have various strategies of, looking at growth in these businesses. So we work with them to grow their loan book, and we are an origination tool on a majority basis, right? So on growth businesses, as always maintained, because we are as a company with thick balance sheet, we are a very young company. Our journey in really digitizing trucking and building the future of Indian trucking has just started, and probably line verticals which are of very high relevance and changes customers life have really not yet got built out, and we are in the, like, our endeavor in growth businesses is that. So we will always be keeping a very strong aggressive investment outlook in the growth businesses, right? So summarizing, while growth businesses will continue to compound on profitability, we will ramp up new investments in the growth businesses, and continue to really stay true our long-term vision of building the whole digital version of freight, which is needed to really debottleneck logistics and really make trucking very efficient and predictable for the country. Yeah. So with that, I think we will pause and open the floor for questions.
Thanks, Rajesh, for the update. We'll open for questions now. Uh, Humble request, please restrict yourself, to 2 questions and come back in the queue if you have any more. The first question is from the line of Abhishek. Abhishek, I'm adding you to the screen. Please unmute yourself and go ahead with your question, please. Abhishek, please unmute yourself. Yeah, please go ahead with your question.
Am I audible?
Yes, we can hear you, Abhishek, now.
Yeah. Like some of our larger fleet management system competitors that are there in US, like Samsara, they are integrating AI in their offerings. Like, are we looking forward into such a possibility in our future? I wanted to know your comments on that.
Yeah. Thank you for your question, Rachin. So basically, the most important, the easy answer to this is yes, because at least our view of AI is that like it'll largely be synonymous to electricity, because anything you do, you want that to be more intelligent, less manually dependent, and so you would essentially in the long term embed AI in like almost virtually every product offerings which we have. And today, if you're asking me whether application of AI we use across all our product offerings, answer is very much yes. Now, helping you understand like in terms of products in Samsara versus products what we have, right? So if you look at the whole suite of products of Samsara, they start from basic vehicle tracking, which they call as ELD, to the advanced GPS devices, to dash cams, to like various different sensors for monitoring industrial applications. They have a very wide range of products, right? Now, if you look at the same context in the Indian market, right? Indian market, the entire go-to-market in telematics has been more price dependent, right? So for a product which on an average price is priced between $20 to $100 per month for a GPS device in the US markets and the European markets, in India, the right product market fit was like for us happened only at like $2.50, which is like 200 rupees plus is what we can make from our customers, right? So that's point number one. Point number two, so hence in India we've been largely successful in low spec, like very thin use case kind of products, right? Point number two, in terms of let's say the places where AI is much more useful and like where you can really create a difference is basically in the area of video analytics in the dashcam sector, right? That particular product for us still is in the experimentation phase. We're still figuring out the product market fit, figuring out the utility, figuring out the price points, figuring out how to create this at a price point which these customers would love, right? And so what I would say is that, let's say now, if you are asking me where are we using, We are using this in probably the fuel sensor product, like to be able to really show accurately the levels of fuel, clean, the whole data, etc. We use AI a lot in our superloads business, right? We use AI a lot in our classifieds business to be able to show the right load to the customer in terms of the ranking of the load when he is looking at it, to the right repositioning of the asset for him in terms of where he has to go. Those are the problem statements we are using AI today.
Okay, okay. And what is our do you have any data as to what is our market share in the loads business as of now?
Yeah. So market share in the loads business can be measured in two ways. One is digitized loads. What is our percentage which we drive? With reasonable confidence, I think in India on a digitized loads platform, I think we are by far by a big margin the biggest. So I think there our market share probably would be upwards of 90%. But in terms of being able to digitize the loads, of India's loads digitized, our broad estimate is that FTL line haul loads, which are long distance loads, typically in a day, 7 lakh to 8 lakh loads happen, right? Typically. And on a like live loads market share basis, we can broadly estimate anywhere in the range of like 7 to 8% are the loads which typically are live at any point in time on a classifieds platform.
Okay. So there is role of network effect in our businesses, right? Once we have big market share, competitors will have difficulty in entering.
Of course.
Is my understanding correct? Okay, thank you. Thank you.
Thank you. Thank you, Abhishek. The next question is from Gaurav Malhotra. Gaurav, I'm bringing you on screen. Please unmute yourself and go ahead with your question. Gaurav, can you please unmute yourself and go ahead with your question?
I have unmuted myself. Can you hear me?
Yes, we can hear you now.
Yeah. So I was just saying that in tolling, your market share will be roughly, give or take around 50-ish%. Where do you think this market share can potentially go up to?
See, basically, the acquisition market share is materially higher than the current market share on the flow through. So we believe that that acquisition market share has been also climbing over the years continuously. So till the time the acquisition market share is materially higher and way higher than the current flow through market share, it'll always keep catching up to that number.
And in terms of gold subscription, if you can give us some sense of where you are at in terms of penetration, what's happening over there, any details which you can share with us?
It was in the early 20s, maybe a year back. Now more inching towards the mid part of the 20s, right? But it'll be in that range roughly. Yeah.
So that'll be the penetration amongst your users, the truckers.
Yes.
Okay. Just one or two small more questions. In terms of fuel sensor, that seems to have picked up. In terms of within the users who obviously were having the tracking system, where would we be in the penetration of in that journey, or is it a completely new set of user who's basically taking it?
90% of the users are all existing users of the platform. 95%, I would say. 95% plus. And in terms of penetration levels, very early days, because we have 8 lakh users. And I think, very early days. I think the whole penetration game is still left to be fully played out. And in the minds of the consumer, he is thinking of more as that I had a vehicle tracking device. Now I'm upgrading into a fuel sensor, which gives me vehicle tracking as well as the fuel sensing ability. So that's how it works. And obviously it have very high value proposition in terms of fuel pilferage, theft monitoring, managing driver, etc. So that really gets the ROI to him.
This last one small question. In super loads, you mentioned that you're going from 4 to 14. So this will still be like within South, or you are now sort of going to go a little bit, wider in terms of say little
Pan
bit in
India.
West,
So
or
we'll be going pan India.
okay. But would like a 14-ish kind of a hub, kind of a system be like dense enough from a superload perspective? How should we think about it? Or there is
Yeah.
or in other ways, like is 14 sort of the starting point, and obviously it has to go much deeper.
Exactly. So basically, let's say, for example, we want to go to West, we want to go to East, for example, right? So you will start off in Calcutta, right? And then you will figure things out after that. I mean, because if you have the option in East to go to one place, you'll only go to Calcutta, right? But then if you want to further deepen, then you'll start Patna, you'll start Guwahati, like you'll start expanding, right? So this is the first probably, points to, just touch upon and then like figure things out. On a databases, India has roughly 350 to 400 like industrial hubs all across the country, right? And the top probably 50 to 100 are very material ones. And in that, like right now, it's really less of a choice, more of a rejection that where our product will probably fly much stronger, where our dense penetration is supply is like super normal. So we are just choosing those as sort of a very easy hubs to move into.
Thank you so much.
Your next question is from the line of Sachin Dikshit. Sachin, please go ahead, unmute yourself.
Hi Rajesh, congratulations again on a decent set of results. So to start with, I wanted to understand the replicability of Superloads model, right? So obviously you are currently in 4 hubs, and let's say tomorrow you are present in 12 hubs, right? Can we build a thesis that yes, this business works, and you will be present in the most major hubs of the country, and you can have a sustainable business there?
Yeah. So to appreciate the modularity of this, right? See, basically, I mean, we are not recreating this business, or it's not a technology innovation which is leading to a creation of a service. This is a matchmaking service which exists in the industry as an offline industry today. And as I mentioned also previously on calls, that this kind of a matchmaking business is done by like 2.5 lakh brokers in the country today, right? And and if you look at a typical activity of a matchmaking activity, right, it's nothing but you need to build demand, you need to build supply, you need to do the matchmaking, you need to manage payments, you need to manage in transit, right? So this is like a modular activity, right? So the confidence which we've been able to get is that, like, first of all, our approach to this was to break this down into all these logical activities, and all these are independent teams, and these independent teams need to do their independent activities, right? At the same time, supply is nothing but driven by the whole platform, and then demand has to be raised by a demand team, like we do in the classifieds business. Fulfillment is done by a team which is separate. Collection, like payments, is processed by a team which is separate, right? So this has been successfully executed in the hubs of Bangalore and Hyderabad at a sufficient scale. Assuming that we need to reach, let's say, a business size of maybe a $2.5 billion in flow through, or $200 million in net revenue, roughly, right? So, and that scale, you probably let's say, for example, you need 40 hubs to do that at like X orders in every hub, for example, right? So with reasonable confidence, we've been able to prove X by 2 at least, right? So for a very large scale business, if you push that down to a particular hub level, we've gotten to that 50-60% proof point at one hub level. Now to do that at a hub level, the pods, like each of these pods, like essentially have been created, and they run independently basis metrics data, right? And you basically hire teams, they come in, they are trained, they learn the industry, they work with us for 2-3 months, and then they get to a particular productivity levels where we break even, right? Which is generally within 3 to 4 months, right? So that has been proven successfully within let's for example, Bangalore, when I'm saying a Bangalore hub, for us, Bangalore is actually a micro hubs of, 4 points. So this has been successfully proven across these 4 micro hubs. Similarly, Hyderabad for us is 3 micro hubs, and Chennai and Mumbai has been 1 micro hub, right? So like, though it is 4 hubs, micro hubs have been like closer to 10, and we've been able to prove this across these micro hubs. That gives us a confidence to say that the granularity in replicability is there, and we would be able to do that across 10 incremental new locations. And so the important point to actually build when we move from 4 to 14 is that what is the expansion strategy? How does expansion happen? How does activation happen? Because let's say, for example, the Bangalore hub, I would visit this hub probably, with a very high frequency, but these 14 hubs, I would not be able to. So then what are these processes metrics? How do you create layers in execution? So that will be the, probably those will be the questions than the replicability of the unit module.
Understood. Understood. Thanks for the clarity. Really appreciated. My second question was on the sort of incremental adjusted EBITDA slide that we used to carry in a few previous presentations. Obviously, you did highlight over the earlier commentary that you did that basically you will try to put pedal on growth, even if, let's say, the payback period extends by a few months, etc. So should we be expecting slightly more? I do understand you will still deliver like brilliant adjusted incremental adjusted EBITDA, but should we expect a slightly toned down version of it going ahead, considering that growth pedal is more important at this point?
So basically, a few things we are doing to like go more aggressive is that, let's say, we would charge, let's say, our customers, for our, let's say, attack, right? Let's say we would like live IFE. Now we are basically running some schemes and offers to like penetrate further, right? To, have much higher market share, right? And probably in some markets where we earlier thought that, let's say, obviously in very good markets, paybacks maybe 3-4 months also. In very bad markets today, paybacks maybe already 12 months, right? But then we are like, okay, but blended CAC level, we're doing really great, right? Why not we still penetrate, right? So I think some of those decisions we would be making in the coming, 6 to 12 months. So maybe, yeah, I mean, a little bit, maybe tapering down, you can probably, expect. But important to note is that in our business, investment today means much more compounding profits in the future, right? So it's actually, but then when will the tide turn towards, really expansion of profits, that we don't know, right? So think of it as whenever we aggressively expand profits, aggressively expand investments, right? Profit growth probably, a little stabilizes. But then once we stop expanding our investments, you suddenly see the hockey stick coming in profitability. So that's the nature of business. And like, as I've always maintained, right? The last 6 quarters, 5 quarters, when I presented you guys our earnings, right? The profitability which you guys are seeing was actually logged like, 2.5 years back. And that was a confidence also of going public, right? Because this is the nature of the business. If you are able to see an investment opportunity which has strong paybacks, we actually typically go intensely, behind it and, chase those investments, because once you steady your investments, you see like, spring back in profitability.
Understood. So should we expect this next hockey stick to be there in 2 years' time? Considering you mentioned like what we saw now was
nothing like that. Like, sorry, I was just, metaphorically explaining all of this properly, right? But the way you should look at it is that, first of all, our investments also will be calibrated, because we don't have too much room, because these businesses have sufficient penetrations. So even the investments will be calibrated. Hence, you can expect the profits also to be calibrated. So everything you can take in a balanced way.
Fair enough. Thank you and all the best.
So next question is from the line of Gaurav Rateria. Gaurav, please unmute yourself and go ahead.
Am I audible?
Yeah, Gaurav, we can hear you.
Yeah. Hi. Congrats on good execution. I have a few questions. My first one is that I think you used to mention the market share in tolling closer to 45, and now you're saying closer to 50. So has there been steady market share gain in the last 6 months?
Yeah, there has been a steady market share gain in the last 6 months, largely commensurate to the similar gains we were doing, over the last few quarters. Yeah.
Got it. Second, on the super loads, could you give example of what is the bare minimum, load or the number of loads that you are handling that needs to happen in a city for it to become a playbook and then kind of replicate it to more micro hubs within the same city? And just trying to understand, like, at what scale it starts becoming a playbook from a replicability point of view. Also, because you are investing, how should we think about the contribution margin for this business? Thank you.
So basically, I think see the module is pretty small. Like if you have a person who can manage 5-6 people, like that's a module you can actually start off with, right? If you're asking the bare minimum module, like hire a team lead who's a people manager who can whom basically you probably will pay between 40 to 50,000 rupees a month, and you hire young hungry folks whom you pay 20 to 25K a month, like let's say in the team, and that's a minimum module actually. See, the biggest advantage of this for us is that we have, like any marketplace you take, right? There is a demand side of the equation, there's a supply side of the equation. And in any marketplace, you have to keep scaling both sides, on a step-by-step basis, right? Because like if you have demand and supply is not available, demand runs away. If you have supply but demand is not, demand runs away. So you can't add both of them like in big quantities together. We have been able to, obviously it's taken 10 years, but we've been able to break this problem down into, we have supply now, right? And then now it is only about demand development. Demand in this industry is always hungry for trucks. If you go to any shipper and talk to them, they will every time go to multiple brokers and, like, let's say, try to get a truck, right? And every broker's fulfillment rates are between like 10% to like 20%, right? So every broker every day gets 30 indents, but he typically is able to fulfill like 2 to 3 orders a day, right? So and that leads him to make a net earnings every month of like 2 lakh rupees, upwards of 2 lakh rupees, right? So this is what we are trying to replicate, leveraging a technology platform, right? So hence the need of a big module to start is not there. The node is actually fairly small, and like the initial times whenever we have set up this node, very smallest node, because of it's very small, control is higher, you typically break even in like second, third month, right? At a branch level, at a city level, right? So that's the context on basically the node and the replicability. From an expansion perspective, how to look at contribution, how to look at like impact in terms of total burn. I would say for us also, we are too early in terms of really understanding expansion leads to what kind of losses, and how to factor the slope, how to factor the break evens at this point in time, because our large evidence of scale up has happened only in the last 3 months, because this team would have been probably like under 50 people team maybe 3 to 4 months back. Now this team is already like 250 people team, and like we really don't have we don't have much guidance into that. We are also figuring out, maybe in 2 quarters we may be able to guide you on how to really model the contribution and losses in this particular business.
Thank you and all the best.
Next question is from Abhishek Banerjee. Abhishek, please unmute yourself. Go ahead with your question. Abhishek, please unmute yourself and please go ahead with your question.
Hey, hi. Am I audible now?
Yes, we can hear you.
Great. Thanks. Thanks for the opportunity. Rajesh, just wanted to understand the core business growth. Last quarter was about 40% YOY, and this quarter it is about 37% YOY. I mean, if you could, help us better understand how to kind of model this for the full year. And also, I think last year you mentioned that the growth was being driven by the GPS business, whereas this year it was more by the this quarter it was more by the fuel sensor. So, is there any natural correlation between the two?
Yeah, so I think one is basically how to look at growth, right? So first is like a good part of revenues like come from the tolling line vertical, right? And again, the next substantial vertical is basically your telematics vertical, right? GPS and AIS business vertical, right? When I was explaining the levers of growth, see, every business provides a lot of adjacencies, right? So when I was explaining how the whole playbook of growth is being built out, and whenever we've talked about growth, we've always talked about the numbers of around like 25% levels is how we look at growth. Because all the adjacencies, when they come up and compound into growth, is a bit unpredictable, because every business is a mix of core, like very core solidified verticals, which we can, project out, understand, and the adjacencies, right? So the way to look at growth, obviously, two parts: adjacencies, how will they grow, and core, how will they grow, right? In terms of core, tolling, again, like indexing this on, you obviously have the public numbers on how NATC is growing, right? But then underneath the hood, you can look at what is the kilometers of national highways, which is cannibalizing state highways, right? How is that growing? How are number of vehicles which are using the like national highway, how is that growing, right? Because the number of vehicles grow and they use more national highways, right? How is the inflation on the toll fare is growing, right? And obviously a little bit, how is our penetration of our value-added services is growing, right? It's a mix of all of this. And we like obviously give you the metric on how our payments GTV is growing. From there, you will be able to really extrapolate how the tolling business is growing. Right? GPS, on the other hand, GPS aided by GPS AIS device, which is a mandatory device in various different states. This gives like a good kicker, because AIS gives the kicker. GPS is obviously a good modernization kind of a story, because as truckers get modernized, they will utilize these services more and more, right? So both of these, again, we've typically guided in the similar sort of zone. We typically have not guided as a strategy, but to help you out how to model this out, right? So this is how the core works. But then now on top of this, like there are a lot of experiments running on how we should really look at fuel cards. How do we run credit programs on fuel, leveraging the dealers? We're doing a lot of different work over there, right? At the same time, under telematics, obviously fuel sensor has broken out, but we are doing a lot of pilots on various different telematics products, right? Because telematics in India is large about how do we translate the innovation, but not really about innovating, because the West is far ahead in telematics, right? So blended all of this, as you're seeing, we're able to do this 37% growth in the last quarter, right? And hence, like that's how you should look at the overall growth modeling for the core businesses.
Understood. Understood. And with regards to the superloads business, what would be the average, value of, one transaction on the superloads business? And if you could just, give a split of the net revenues. I'm not sure if you've given it previously. I may have missed that out.
Yeah. So I think what we've always maintained is that we will, at the relevant time, start increasing the disclosures with respect to the superloads business, right? But to give you some like narrative on how does the industry work, and like let's say in terms of the gross revenue per transaction, etc. So India, if you take the overall India average, the gross average revenue for a load, average gross rate value for a load typically would be in the range of about 50,000 rupees, right? And an offline industry, for the whole brokerage industry and the probably the booking office, everything, whole industry typically makes a 15 to 20% kind of a gross margin. Brokerage layer typically makes anywhere in the range of like 8 to 12% margin in this industry, right? Today, obviously, because we are largely doing regional lanes, our gross order values are much lower than this. Yeah, so this is broadly what we can share.
Understood. And just one last question. So one of your competitors has recently announced that they will have a platform which will show the prices for most of the lanes across the country. So that kind of takes away some of the information asymmetry which is there in this segment, and which obviously would mean higher realizations for platforms. So, any thoughts on that? I mean, would you sense that the competitive intensity is going up here right now?
Yeah. So basically, I don't know the competitor you're referring to, right? The majority of the competitors in this business are in the organized transporter layer, right? Who typically provide services to the end customers. We don't compete with them, number one. Number two, the pricing in this industry is very heterogeneous. Let's say from Bangalore to, let's say, Delhi, or Bangalore to Chennai, the whole pricing at a daily basis typically is in the band of 15 to 20%, right? And it's very, and that pricing is right and true for that particular micro market and for that particular product category, right? So let's say, for example, if you're using the same truck type, 32 feet multi-axle container for like, two different, shippers on the same lane, same distance traveled, the pricing may still be 10% different because one particular customer's warehouse has a lot of detention, right? Or one particular customer may have a material which is far lighter, but it needs that particular, truck type, right? So pricing is very heterogeneous, and pricing is very, micro market dependent. And I would say that if more and more players can come into this industry and do this kind of work, we will be able to faster crack this market than actually we, like, let's say, being a lone ranger and like with very few players trying to do this.
Understood. Very helpful. Thank you so much.
The next question is from the line of Parikshit Kabra. Parikshit, go ahead. Please unmute yourself.
Hi, am I audible?
Yes, we can hear you. Go ahead, please.
Okay, great. So my first question, okay, first of all, congratulations, Rajesh, for your results. But my first question is about the type of fleet that we have. From my research, what I'm hearing or understanding is that one of the type of trucks that we may not have adequately in our portfolio are those container trucks. And based on my research from some of the other people, other tech players who are also trying to enter the space, it seems like they also struggle in onboarding container trucks on their fleets. So I'm just trying to understand whether this is just a random occurrence, or is there something structurally different about tech players like yourself in on terms of onboarding container fleets, basically?
Yeah. See, basically, first of all, if you look at the market segmentation in terms of truck population and ownership, 75% of the 75% of the trucks in the industry are owned by people who own less than or equal to 5 trucks. That's point number one. Now, if you look at the share of people who own, let's say, more than 5 trucks, as a percentage of that, they would be owning more containers. So my comment there is large fleet owners typically own large number of containers, right? And these people, let's say, for example, when we were like trying to add users using a tolling or a vehicle tracking service, etc., as it is 2019, 2020, these guys, because they were bankable, they were a profitable businesses for, let's say, maybe like a large Western telematics company, or by a HDFC bank, or by an ICICI bank, became their customers quite early on, right? So if you look at our, like, let's say our percentage, like, let's say, for example, if India has 10% large fleet owners who own more than 20 trucks, for example, right? Our percentage of that would be like 6%, right? So on a relevant proportionate share, obviously we are lower on a platform basis because they were penetrated by some of these players because of the profitability of that business, right? That's point number one. Point number two, your obviously question is right, that do we have containers? Answer is yes. But do we, like, let's say, really dominate in containers? Answer is no. But at the same time, today, percentage of vehicles in the superloads business, or be it in the classifieds business, which get placed by containers, that number is also 40%. So it's basically 40 to 50%. So that it's basically, yeah. So classifieds, as you rightly said, let's say you may have the voiceover by the customers that we are not able to find containers properly because the availability of trucks is so high that they feel bad in containers. At the same time, when I look in super loads, right, when a customer repeats, right, he starts repeating, right? So even though he is not a customer, he's maybe a customer for only one of the other product categories, or may he has joined the platform only for classifieds, right? Or he joined the platform only for super loads because he started super loads, right? So the repeat is typically very high for containers as well, right? So your question, answer to your question is definitely yes, that proportionate share is lower, but containers are available. But do customers struggle in finding containers who are classified customers? Answer is yes. Do we have high share of our loads on containers? The answer to that also is yes.
So as a follow-up, Rajesh, on that, first of all, thank you for that. But as a follow-up on that, then would it be fair to say that to some degree, our loads marketplace or even the classifieds business would be throttled in its growth because of our inability to have adequate number of these container trucks? And if so, how are we structurally solving for it? Because see, the problem that you identified, which is that these container trucks are typically with larger organized players who we have not managed to tap into, that still persists. So how are you going to solve for that?
No. So, sorry, like what I meant was, first of all, there are large, see, first of all, India has a $200 billion of trucking TAM, right? 180 to 200. In that, which comes into brokerage is 120, right? Let's 60% of that. First of all, these organized guys may have put the trucks with, let's say, a PTL provider or an express provider. I'm not even calculating that in the TAM, right? So the TAM is X of that. The problem is that the overflow needs of these come into the brokerage marketplace. For the overflow needs, any which ways you will not find trucks. So answer to your question is, for the relevant share of demand which actually comes into the open market, those many containers I think are available in the open market. So it would not throttle. That's point number one, because we've seen that play out in the business, in the markets we are in, and like Bangalore is a significantly container market, and we've been able to scale up significantly over here, right? So the answer to this question is that first of all, containers is a very small share of the overall market. Number two, have been able to find containers on our platform? Answer is yes. Have been able to scale containers? Answer is yes. Higher market share of our business is containers? Answer is yes, right? Yeah.
Correct. Second question I had, Rajesh, was I understand that you guys are planning on doing massive investments in all the new growth areas, and that's fair enough. And I think this quarter, in terms of our cost line items, we have already seen some of those investments. But from a quarter-on-quarter growth perspective on our growth business, we have gone from 23 crores to 28 crores, which is obviously great growth on if you look at it out of context. But from the idea that we have just managed to crack this model to some degree and we are scaling up operations so rapidly, does this growth look adequate to you from a top line perspective?
Yeah, you're absolutely right. I mean, this growth from a perspective of what this can be is definitely not adequate. And but like let's say the entire aggressive outlook into superloads is quite recent of the last 2 to 3 months. Yeah.
Got it. All right. Thank you.
Thank you. We'll close the Q&A session now. Thank you everyone for hearing us out. I'll hand over to Rajesh now to make the closing remarks, and then we'll close the call. Rajesh, over to you.
Yeah. Thank you everybody for making it to our earnings call, and I think we had a good first half of the year. And yeah, more importantly, as I understand, all of you are on a holiday, and I think on a holiday joining the call and hearing us. Thank you so much. Special thanks for that. And see you guys again soon. After one quarter, and wish you all very best. Yeah, signing off. Thank you.